Yo, yo, yo. What up? What it do, YouTube? It's your boy Ascension Capitals. And today I want to show you guys a little basics on market structure. Now, market structure is a very important element when it comes to your trading and your performance. One thing I want to iterate is, if you're trapped on the wrong side of the market, most likely you are on the wrong side of market structure. Excuse me. So, that being said, what we have here is a bit of a bearish scenario. And when you see these purple highlighted points, let's assume that this is 4-hour structure. Now, when it comes to 4-hour structure, you always want to analyze the outermost swing points of the structure being printed. So that is these highlighted areas here. You have a high, a low, a lower high, lower low, lower high, lower low, lower high, lower low, and so on and so forth. And also what we have here is expectational order flow, meaning this is what you would see 9 times out of 10 being shown in examples of market structure, whether that being, in a course or in some sort of textbook. But this is what expectational order flow looks like. And when these swing points are being broken from a high to a low, the next point that's being broken would be considered a break of structure. And what a break of structure means is essentially you are gaining more strength within the market, breaking past the previous outermost swing point of structure. So this is when you see price action acting in this manner, this is an occurrence of, okay, sellers are in control and sellers are pushing the market bearish. And here in this scenario here to the right, this is more of a reality-based sort of scenario and how you would see the market in real time. So in this scenario, again, we always want to gravitate to the outermost swing points of structure, whether that be this high, low, lower high, lower low, lower high, lower low, lower high, lower low, and so on and so forth. And a lot of times what I myself am guilty of, and what I see a lot of other traders do, they're getting lost within this structure, being zoomed in too close and not looking at the bigger picture. And that's a very common mistake made when you're analyzing market structure. And remember, structure, all it is the direction or the overall sentiment of the market, meaning where's the market gaining strength? How is the market behaving? And that is something that you want to keep in mind. Again, we have here a low, an outermost low being broken, and that being a break of structure, causing more strength to being produced within the market. Again, another scenario where we are breaking past the previous swing point of the outermost swing point of structure, and that is something to really help you to know where you are in alignment with your lower time frames if you trade lower time frames, or it allow you just to know where you are overall on your 4-hour time frame. But yeah, so these two scenarios are bearish scenarios in market structure and a bearish sentiment. Expectational, which is the market would never look like this in this manner, this kind of perfect zigzag up and down, breaking past each structure point pretty smoothly and cleanly, with a smooth pullback and a smooth transition. And most likely the market will never happen in this way. it'll always look something more like this reality style when there's a bunch of minor and major pullbacks and fractal structure, and then it's continuing its direction in its intended direction. So this is a scenario of bearish sentiment, and I'll show you guys a scenario of a bullish sort of sentiment. So here we have the same thing. When we're analyzing market structure, we want to gravitate towards the outermost swing points of structure. The outermost swing points. It's easy to get lost on the inside, but you want to be analyzing this on a larger time frame, whether that be the 4-hour or the daily or the hourly, or maybe even the 15-minute for some folks. But remember, the outermost swing points, I can't really reiterate that enough, because if you lost in structure, 9 times out of 10 you're going to hurt. You're going to be crying. You're going to be devastated on why I keep getting stopped out. Why is the market always stopping me out? I can never be on the right side of order flow. So this is the expectational example of a bullish sentiment, where the market is perfectly delivering these lows and these highs and these pullbacks and these deliveries. But remember, the market always going to look something like this. Whether it's more complex pullbacks within the range, there's not, it's a lot more choppy than what you would actually see in this drawn example. But I'm going to show you guys more of a, real life scenario inside the charts when we get to the charts. But again, here, when we are breaking past those swing points, those outermost swing points, creating a new high or a new low in a bearish scenario, we are gaining strength within the market. Break of structure has happened, has been put in place. So you can expect, after a break of structure has been put in place or a previous swing point has been broken through, you can always expect the market to have a pullback into some sort of discounted area, or maybe the 50% of that range. But moving forward, price will continue to put in new highs and new lows until we break past the outermost swing point of the structure. Again, here we got to break past that previous point. What happens? More strength is being gained within the market, because the market never really just goes up after it breaks these sorts of swing points. The market can't just, fly up in one direction forever and never come back. That's just not realistic. The banks and would not let that happen whatsoever. But again, you're just continuing the order flow, or you're continuing the sentiment of structure. And this is a break of structure in a bullish scenario. So I kind of want to get into the nitty gritty and show you guys a little bit more on how we would analyze this in a real time or a real life scenario. Let's see here if I can find where I'm at, where the example was at. Let's see here. February 23, August 20, let's see. December. Okay, let's go here. Now, in this scenario, can you guys already spot structure in the outermost swing points of this daily structure? Or maybe even I should go down to the 4-hour. Now let's analyze the outermost swing points of structure. And can you guys see anywhere or any direction where the market is heading? Okay, obviously we can see that the market is trending up and we are placing in new highs and new lows. But let's go out and mark out these together to kind of show you how this would be applicable in real time. So the first thing I see here, starting from the left side, I see this major low. Then what happens? Price rallies up, breaking past previous structure, breaking past this previous structure here. this swing point here. Oh, wrong button. Breaking past this previous structure here. So this would be considered what? A break of structure. Yes. So in this scenario, price is, or strength is being gained within the market. And remember what I mentioned. After these sorts of new highs are being put in place, being at this high, we always going to expect some sort of pullback. Remember, the price doesn't just go up forever and never come back or return for a pullback or anything. That just doesn't happen. The banks and institutions would not let that happen. So, and we start to pull back. So in this scenario, this would be our new trading range. From this high to this low is the new trading range of structure. But that is another video for a different day. So this would become our protected low, meaning as long as price doesn't break below this point, we are still indeed bullish. So again, let's analyze. Where is the next outermost swing point of the pullback before price broke past this swing point? It would be this low here. And this will be our new lower high. And let's continue on forward. And we wouldn't have a new higher high until this high is being broken. And as we can see, this high did not break past this high. So we are still, again, ranging between this high and this low. So price did whatever it did right here. It was kind of ranging for a little bit. But then price came back and gave us what we were looking for. Price indeed broke structure here. Again, gaining more strength within the market. So our next swing point would be here. After price broke that, put in a new high, and after that new high was put in, we would be expecting a new low to be put into the market. And where's that new low? Here. So again, we always want to analyze the outermost swing points of structure. Let me mark this out for you guys. A break of structure. And again, this high got breached or broken through. So this would be considered a break of structure. Again, more strength being gained within the market. So after we put in a break of structure, we're going to wait for some significant highs to be put in place to where we can see a significant pullback, or a pullback of at least, I like to see at least 3 to 4 candles being put in place. So in here we have some consolidation or range. I wouldn't count anything like this unless it were to give me a significant pullback into an area. So price kind of rallied up for a little bit, doing its thing, and then we finally put in a new high here. Then we put in a new low here. And then at this time, we don't know what price is being placed, or we don't know where price is going to. So this is the types of scenarios when we would wait and be patient and to see where price is going to be next. So let's kind of play this out a little bit, kind of see. Okay, look, this high got broken through. So that would be considered our break of structure, meaning more strength is being gained within the market. So at this point, monitoring price, I would just kind of wait more for a significant pullback to happen, to wait for a new higher low to be put in place, because we haven't really put in a new higher low. Like the range between here and here is pretty big. So at some point I could expect another higher low to be put in place. But this is the types of things you want to monitor when you're analyzing market structure. Preferably on the 4-hour time frame, just because I'm pretty biased on the 4H, but this is kind of what you want to look for when you're analyzing market structure. And the same rules apply when you're looking at a bearish market. So yeah, I could flip this. Let's see if I know a little trick. command inverse. Look at that. Ooh, fancy. So yeah, this would be a scenario in a bearish market. So again, the outermost swing points, you want to gravitate towards the outermost swing points. Again, those break of structure, meaning more strength is being gained within the market. And price continues, and you want to continue to monitor those outermost points. But yeah, man, market structure can be a little tricky if you're not careful, but you always want to, know where you are in structure, because again, it'll cause you a lot of headaches and a lot of pain if you don't know where you are in structure. So that's something you always want to keep in mind. And I think this goes a lot more deeper, and I could go a lot more deeper, but I don't want to overwhelm you guys in this video. I just wanted to keep it as basic as I can, and this is pretty much my understanding of market structure. So I hope you guys learned something today. I'm going to try to be more consistent on this channel and post more videos, whether that be education videos or more blog type videos. But yeah, man, that's all we got for this video. Maybe I'll keep rising. You guys keep growing and doing your thing, and I'll see you guys in the next one. Peace.